welcome to case study number 2. You have 30 minutes to read the question. Now, let's assume that you start with your reading time at 8, therefore you need to stop at 8:30. Guys, I am going to explain to you why I include this once we look at the requirement section. Now, let's read through the scenario. You are employed as an audit senior by Audit Inc., a small audit firm situated in the Northern Cape. Audit Inc. provides audit as well as accounting consulting services to various clients. Your portfolio includes the following 3 clients. Client 1, UberTrack Limited. UberTrack Limited, UberTrack, is a national transportation network company offering services that include peer-to-peer ride-sharing, parcel delivery services, food delivery, and short-term vehicle rental solutions. The company is based in Johannesburg and has operations in majority of the major cities in South Africa. UberTrack is listed on the JSE Limited and has a 31 December financial year end. Leases. Immediately, you are able to identify that you need to think about your IFRS 16 principles. On 1 January 2018, Fleet Rent Limited entered into a contract with UberTrack Limited, UberTrack, in terms of which UberTrack received the right to use at its discretion a fleet of 50 motor vehicles for a period of 3 years. These motor vehicles are motor cars as defined in Section 1.1 of the Value Added Tax Act 1991 as amended and are of a similar model and size. Fleet Rent has a 1-year extension option. Now guys, you know I do prefer to make use of different colors in terms of my different entities. Right, Fleet Rent has a 1-year extension option that will most likely be exercised by UberTrack. In addition, UberTrack has the option to purchase the motor vehicles at the end of the contract term. At inception, it was not likely that UberTrack would exercise the option to purchase the motor vehicles. Now, let's just take this one step back. When we look at our principles in terms of IFRS 16, remember, in the records of our lessor, which will now be Fleet Rent, Fleet Rent will have to recognize either a finance lease or an operating lease. In the records of our lessee, which will be UberTrack, UberTrack will recognize the right of use of the asset and our lease liability. Remember, lease liability will be the present value of the future minimum lease payments, and we need to use this to be able to determine what is our right of use of our asset. They indicate to us the contract stipulates that Fleet Rent accepts the full risk of destruction or loss of the motor vehicles and assumes all obligations in respect of insurance. UberTrack accepts the full risk of maintenance and repairs and is required to reimburse Fleet Rent for insurance. The 50 motor vehicles are identified by registration number in the contract. Unless requested to do so by UberTrack, Fleet Rent may not substitute a vehicle in the fleet for another one. UberTrack will pay 205,073 including VAT at the end of each month as consideration for the use of the motor vehicles. Neither UberTrack nor Fleet Rent incurred any initial direct costs with respect to the lease. The incremental rate of borrowings for UberTrack is 12.5% per annum. Guys, look at this. Our payments will be monthly, but we have a per annum rate. Remember, if you need to determine your present value, your rate should be per month in as well. And the day 1 cash equivalent for the 50 motor vehicles was 6,347,446, excluding VAT. Our payment including and the cash price excluding. The total finance cost of 260,7392 is stipulated in the contract. The contract was concluded and delivery of the motor vehicles took place on 1 January 2018. The first installment was paid on 31 January 2018 and all subsequent payments have been made on their respective due dates. UberTrack estimates the useful life of motor vehicles to be 5 years. UberTrack uses all vehicles evenly throughout the year. Remember, you need to think about your principles of IFRS 16 paragraph 32. If we know that ownership will transfer, we need to use the useful life of our asset. If we are unsure, doubt this, we need to use the short term of the useful life or the lease term. UberTrack provides short-term vehicle rental solutions. UberTrack is a registered VAT vendor that makes 100% taxable supplies. In terms of UberTrack's accounting policy, assets with an individual value of less than 30,000 are regarded as low-value assets. Now, why is this important to us? Remember, if this is low-valued assets, they can straight line this lease. Second section in terms of Client 1, taxation. The financial manager of UberTrack performed the deferred tax calculations based on the statement of financial position method. Immediately, you know IAS 12 principles should be applied. She sent certain deferred tax journal entries to you with notes for your review in order to enable her to finalize the financial statements for the year ended 31 December 2018. Journal 1. Right, they provide us with the dates throughout the journals being 31 December 2018. I'm not going to repeat this. Now, in Journal 1, they debit a deferred tax asset and credit our income tax expense, OCI. Now, guys, they indicate to us that UberTrack purchased vacant land outside Johannesburg for 1 million on 1 March 2018. The land is held for long-term capital appreciation. The fair value of the land amounted to 1.1 million on 31 December 2018. Investment property is measured in accordance with the fair value model in terms of IAS 40, right? Now, I'm pretty sure, guys, our level 1 students, you're going to freak out. Oh, you do not have to know IAS 40. Well, guys, included in this question is everything that you have to know up until the 3rd year level, number 1. And number 2, if you refer back to our IAS 16 lectures in the introduction, I did recap our IAS 40 principles briefly. Okay, so don't freak out. In this question, there will be sufficient marks for you to be able to pass the question without having to include the discussion on this journal, I promise you. Okay, now let's move on. When we look at this immediately, we are able to identify investment property at fair value model, very similar to land based on our revaluation model. Therefore, we need to know that the tax will be based on our CGT. And when we look at the journal entry, they have only used 80%. There's no tax rate, right? And also they have used OCI. Now, OCI we will use when we revalue. This doesn't make sense. Okay, Journal 2. Journal 2, they debit income tax expense, profit or loss, and credit deferred tax. Now, let's read through the scenario. UberTrack purchased a software bookings system that can be used on all mobile devices and linked to the current Uber Bookings application to enable real-time bookings information to be available at all times. Now, we know IAS 38. The software had a cost of 310,000 on 1 January 2017. At this date, the useful life was estimated at 6 years and the residual value immaterial. The search indicated that they will not allow capital allowances on the software. Right, now when we look at the journal entry, they have used the cost of 310,000, divide this by the 6 years useful life, and this is amortization of 51667 times 2. Now times 2 will be the 20.17 year end and our 20.18 year end. And then they will have a carrying amount of 206,667 minus 0 tax base times 28%. Then they indicate to us during the 20.18 financial years, UberTrack's new information was available in terms of this specific software, and the remaining useful life and residual value were re-estimated at 3 years and 30,000 Rand during the finalization of the 20.18 financial year. Therefore, immediately, what do we identify? IS8, and this is a change in estimate. Change in estimate, we need to know that we need to apply this in our, in our current year, as well as future periods. Intangible assets are measured in accordance with the cost model in terms of IAS 38 intangible assets. Depreciation is provided for on the straight line method over the asset's remaining useful life. Right, guys, now immediately when you look at the journal entry, this is at the end of 20.18. Now, they have still used the original depreciation, 6 years. But when we look at IS8, we need to identify that we had to apply this in our current year. Okay, but at this point of time, we don't know the requirement. Therefore, we're not going to waste too much time. Journal 3. Debit, deferred tax, credit, income tax expense, 450,000 minus 0 tax base times 28%. During 20.18's financial year, UberTrack started their research with new power banks to offer to their drivers and customers making use of their services during ride-sharing. This is also a possible product to be sold in a current market with the variability of electricity. UberTrack estimates that during the following 2 years, UberTrack will be able to develop and test the power banks. UberTrack is confident that the first power bank will be available to the public in 20.20. The total research costs incurred during the 20.18 financial year amounted to 450,000. The project was not approved by the Research and Development Adjudication Committee. Now, guys, they cannot capitalize this. When you look at our journal at the top, they have capitalized the 450,000, but they cannot capitalize this. At this point of time, this is research costs. Research costs we need to expense. Journal 4, 31 December 2018, they debit, deferred tax, credit, income tax expense with 750,000 minus 1.1 million times 28%, and they indicate to us that recognition of deferred tax movement in unused tax loss for the year. At the 20.17 financial year end, UberTrack's directors were uncertain of UberTrack's ability to generate taxable profits in the nearby future. But during 20.18 financial year, UberTrack generated taxable profit, and the directors were now certain there will be taxable profit in the future. Below is an extract of the final tax calculation. Right. Now, when we look at this, they've indicated to us at 20.17 they were uncertain, and when we look at this, there is a loss of 1.1 million. But 20.18 they have recognized a profit of 750,000. Therefore, guys, do you see that 20.17 they did not recognize the deferred tax asset because at this point of time they were uncertain. But now, remember, and there is, I think it's paragraph 56, indicates to us that each year end, we need to identify if there is a deferred tax asset relating to our prior year's unused tax losses that we may recognize. Now, in 20.18, there is profits. Therefore, we may recognize a deferred tax based on that assessed loss in 20.17. But we will look at this in detail when we attempt the question. Then they indicate to us total taxable temporary differences. Very important. You should be able to include these amounts in a deferred tax asset calculation. If this is taxable temporary differences, remember this will be a deferred tax liability of 50,000 temporary difference 20.17 and 300,000 for 20.18, excluding the unused tax losses as at 31 December. Therefore, they indicate to us that the 50,000 and the 300,000 does not include the unused tax loss. For Journal 4, you may assume that these amounts are correct and that all the necessary adjustments relating to the above mentioned journals 1, 2, 3 have been made. Guys, please, please, please. Journal 4, you may assume that these amounts are correct. Therefore, please do not try and recalculate these amounts of Journal 4. They indicate to us that this is correct. Don't waste your time. You need to read. Additional information. The normal income tax rate is 28% and capital gains tax inclusion rate is 80% for all periods. The VAT rate is 15%. Ignore any VAT consequences on all of the journal entries relating to the taxation calculations. Therefore, guys, in terms of our journals, please ignore that. UberTrack early adopted IFRS 9 financial instruments and IFRS 16 leases for all the relevant reporting periods. Client number 2, Rockwell Consulting Limited. Rockwell Consulting Limited is an engineering consulting company listed on the JSE Limited. The company had an exceptional profitable financial year ended 31 December 2018 and expects to maintain its profitability in the nearby future. The following information were provided to you for the financial year ended 31 December 2018. Salaries. Immediately when we identify salaries, you need to think about your IAS 19 principles. The following net salaries were paid over to employees. You may assume there is a total of 18 employees and that all receive the same remuneration. Now, when you look at this, they provide us with a monthly amount and a yearly amount. We have gross basic salaries, medical aid contributions, provident fund contributions, taxation pay as you earn, and net salary paid over to our employees. In addition to the above, Rockwell Consulting Limited also contributed the following towards their employees for the year ended 31 December 2018. Medical aid fund contribution of 1584000, provident fund 554400, and there is an additional provident fund contribution of 80,000. All payments are made at the end of each month except the payments to the South African Revenue Service, which is paid on the 7th of the following month, and the additional provident fund contribution, refer point 5. Right, guys, now when you look at this, remember, pay as you earn will be paid by the 7th. Therefore, if this is paid by the 7th, this will be a liability and accrual at year end in the records of this entity. Okay, so guys, you will also have to think about your principles of IAS 37. Why? Remember, when you think about a provision, this will be an uncertainty in terms of either the amount that will be paid or the timing in terms of when this will be paid. Now, when we look at this, guys, we know that the pay as you earn, we know the amount, we know the 7th, therefore an accrual. But in terms of our provident fund contribution at this point of time, we still need to refer to point 5. During December 2018, management approved a 7% salary increase to all of its employees for the 2019 financial year. To leave. Each employee is entitled to 21 days of vacation leave per year. Unused leave accumulates for 1 year and will be paid out to employees if it has not been utilized, therefore not been used during this period. Any leave payments to employees that did not utilize their leave by the due date are calculated on their gross basic salary and paid net of any taxation. You may assume that there are 260 working days in a year. The following information pertaining to Rockwell Consulting Limited's leave balances were made available to you. Because now, let's just quickly stop right there. They indicate to us, guys, that unused leave accumulates for 1 year and will be paid out to employees if it has not been utilized during this period. Any leave payments to employees, when we look at this, leave payments to employees that did not use their leave by the due date are calculated on their gross basic salary and paid net of any taxation. Therefore, the leave not used will be based on the gross basic salary. Therefore, when we look at the scenario, our gross basic salary amount, right? Now, in terms of leave, they provide us with our leave accrual on 1 January 20.18. The leave utilized, therefore used, during 20.18. Now, days, 105 days, which will be our opening balance of 105, then used 415, therefore we need to take this out. How much leave will accrue? Take this out, they've used this. We need to determine how much leave accrued during the year, add this, and this will then be our closing balance. Right. Rockwell Consulting Limited estimates that 50% of unutilized leave on 31 December 20.18 will be utilized, therefore will be used in the 20.19 financial year. The company do not expect any resignations in the following financial year. Therefore, they indicate to us, based on our closing balance of our leave, okay, so guys, I just want to delete this one, plus it's going to irritate me. Okay, based on this closing balance, 50% will be used and 50% will be paid out. How do we know this? Because this is what they've indicated to us in the sentence. Rockwell Consulting Limited estimates that 50% of unutilized leave will be utilized. Therefore, if they use 50%, we can assume that 50% will be paid out. Maternity leave. On 1 October 20.18, one of Rockwell Consulting Limited's employees allocated to a project in Pretoria went on maternity leave for 4 months. According to the company's leave policy, maternity leave will only be fully paid to the employee if the employee returns to the company for the same period the maternity leave was taken. Now, when we look at this, remember this amount is already included in our gross and net salaries. 4. Bonus. On 31 December 20.18, Rockwell Consulting Limited awarded a 40,000 Rand bonus to each of its 18 employees based on the year's exceptional financial performance. Employees have to remain in the service of Rockwell Consulting Limited until 31 December 20.19 to receive 70% of the bonus. And they need to remain in the service of Rockwell Consulting until 31 December 2020 to receive the remaining 30% of the bonus. Right, now guys, when you think about IS 19, remember IS 19, we need to distinguish between our short-term employee benefits and our long-term employee benefits. Now, when you look at this, guys, the first 70% will be paid within 12 months and the remaining 30%, not 30 months, the remaining 30% will be paid the next 12 months, therefore 24 months. But guys, overall, when you look at this will be in our long-term employee benefits. Defined contribution plan. Due to the company's exceptional financial performance, an additional provident fund contribution was made on behalf of 2 retired employees who were paid of the part of the fund. Who were part of the founding directors of the company. The intention of the incentive was also to retain existing employees. The 80,000 Rand was paid on 8 January 20.19. Guys, we know the amount, we know the date. Now, when we look at this section, remember this 80,000, the additional provident fund contributions were made, right? And they've paid this on the 8th of January 2019. Containerized cafeteria. On a remote site where 8 of Rockwell's Consulting Limited's employees are working, the company has temporarily erected a containerized cafeteria to allow staff easy access to affordable meals. All Rockwell Consulting Limited's employees' meals are subsidized, and the company contributed R2,000 per employee to subsidize meals in the current financial year, short-term employee benefit. General information. You may assume that the normal income tax rate is 28%. Assume that Rockwell Consulting will have sufficient taxable income and feature to utilize any deferred tax assets.